Chapter 14, Transaction Review. In this chapter, we covered a number of transactions along with a lot of vocabulary. But the first thing we did was we estimated uncollectible account expenses. And again, we're going to analyze accounts receivables according to when they are due. And this is called our aging accounts receivable. So again, if you remember, we went through and we figured out all of the accounts that are 1 to 30 days due, and we figured 4% of those will be uncollectible. And then we did the same with the other pay periods. Then on the bottom part here, we went through and we figured out how much is our estimate for uncollectible accounts. Now this is just an estimated amount so that we can prepare our adjustments. Okay, so we take the amount that we figure we're not going to collect for this pay period, and then we're going to subtract what is already in that account. Let me grab the right pen here. We're going to subtract, and then this is the amount that our adjustment will be made in our journal. Going on to our adjustment in our journal, the accounts receivable again that cannot be collected are uncollectible accounts, and it's recorded in the uncollectible account expense. Crediting the estimated value of uncollectible accounts is a contra account, and again, this is called our allowance method of recording losses from uncollectible accounts. So again, the first thing we want to do in our journal is we would write the title Adjusting Entries. We are going to debit our uncollectible account expense, and we're going to credit the contra account to accounts receivable. And again, it's for the amount that is circled on this slide that we had figured out we needed the adjustments. So those accounts should be brought up to date. After our adjustments we went through some transactions. The first one was writing off an uncollectible accounts receivable. When a customer's account, again, is determined to be uncollectible, a journal entry is made to cancel the uncollectible account. And again, this entry cancels the uncollectible amount from the accounts receivable in the general ledger and the customer accounts receivable ledger. Remember, canceling the balance of the customer's account because the customer does not pay is called writing off an account. So here again, we wrote off Edmonds Hospital past due account as uncollectible. Okay, so we're going to debit allowance for uncollectible accounts. And again, remember, the allowance for uncollectible accounts is only for an estimate. Now we know it's not going to be collectible, so we're going to take it out of that account. Allowance for uncollectible accounts has a normal credit balance. To take it out, we will debit that. And then we are going to credit the accounts receivable. Edmonds Hospital, we will credit that amount to take it out of his account. Remember, when we write them off, we don't tell them we wrote them off in hopes that they come back and pay. The third entry that we made into the journal was reopening an account that was previously written off. And again, a business writes specific accounts receivable after determining they won't be collected, and sometimes after the account has been written off, the customer pays the delinquent account. Remember, 2 journal entries are recorded for the collection of the written off accounts receivable. We're going to have a general entry that reopens the customer accounts, and then the second one is an entry for a cash receipts journal that records the cash received. So when we look at the first of the 2 transactions that occur when we reopen an account, receive cash in full payment of an account previously written off as uncollectible. So the first thing we have to do is reopen the account. So we're going to put the money back into the accounts receivable, Edmonds Hospital. and we will debit that. That will increase our accounts receivable. We're also going to credit allowance for uncollectible account and put that back in the estimated amount. The second part of this is to record the cash received for an account previously written off. So we receive cash in full payment as it's written off. So we're going to go to our cash receipts journal. We will debit cash for the amount of cash received, and we will credit Edmonds Hospital. And then we record, of course, the date and the document number. The third transaction dealt with notes receivables. Okay, remember that when banks and businesses lend money to another business, a loan agreement is made and a promissory note is written out. The note doesn't pay the amount the customer owes. It's just the form of the assets changed from an accounts receivable to a notes receivable. And when a customer signs a note, the principal amount is debited to the asset account titled Notes Receivable. One asset, accounts receivable, is replaced by notes receivable. And again, this is like giving out a small loan, which eventually you're going to earn some interest. Okay, so here we're accepting a 90-day 8% note from Skinner College for an extension of time on its account. Okay, in this transaction, we write the date. We're going to write notes receivable for the total amount, and we will credit accounts receivable. So we're taking it out of the accounts receivable and putting it into like a small note or a small loan. Next, we can collect the principal and interest on a notes receivable. June 16th, we received cash for the maturity value of notes receivable, a 90-day 8% note. The principal is here, the interest, and the total. Remember, when you're figuring out your amount of interest, you take the principal, which would be $2,578.35. You take it times the interest rate of 8% times the time, which is 90 days out of 360 days. And remember, we use 360. The business world uses 360 in this book. And that's how you figure out your interest. And again, it's all figured out for you, but a lot of your problems it is not. Okay, so our notes receivable will be credited for the amount of the principal. Our interest income will be credited. Our income is going up by the amount of our interest. And the total amount of cash we received is both the principal plus the interest. And the last one was recording a dishonored notes receivable. When a notes receivable When a notes receivable is dishonored, we have to write it off again. The balance of the notes receivable account should only show the total amount of notes that probably will be collected. The amount of the dishonored notes receivable should be removed from the notes receivable. The amount plus the interest is still owed by the customer. Therefore, the total amount owed should be debited to the accounts receivable in the general ledger. All right, so we've got this one. Stout Company dishonored note receivable for 60-day note, 8% note, maturity value due today. Okay, they dishonored it. We have to take it out of our notes receivable. So our notes receivable here will be credited to remove it from our notes receivable. Okay, the interest, we have to realize the interest that they owe will be credited because that account is going up. Then the total amount of the principal, the $3,000 plus the $40, is owed by accounts receivable, Stout Company. So originally, when they had the accounts receivable, they owed $3,000. They got an extension, which was in the form of a notes receivable, and they borrowed the money for $40. So now they owe $3,040. If they don't collect on that, then we would have a dishonored account.